Okay, let's unpack this. Today we're diving into a market that, well, it might sound specialized, but it really tells a huge story about global industrial growth. We're looking at the global Ionomer market, and we've got some great data here from cognitive market research, tracing the forecast from 2021 all the way out to 2033. Our mission really isn't just about rattling off numbers. It's more about understanding this fundamental shift that seems to be happening in global manufacturing. It's kind of a story of volume versus velocity.
Hmm.
You have these traditional Western markets holding the biggest revenue volume, but the fastest growth, the real speed seems to be happening elsewhere, where industrialization is maybe younger.
Yeah, exactly. And it maybe just to set the stage for anyone listening who isn't deep into materials science, what are we actually tracking here? Ionomers are, well, they're specialty polymers. Think plastics, but with ionic groups attached. So they aren't your typical commodity plastic. These are critical for really demanding applications. Things like high performance packaging, components in solar panels, specialized seals for EV batteries, even high-end golf ball covers use them. So tracking this market's growth gives you a direct line into where that high-end demanding manufacturing is really taking root across the globe. And the global numbers, they immediately show a really strong path forward. Back in 2021, the whole market was worth just shy of half a billion US dollars, around $496.5 billion. Fast forward to 2033, and that revenue is projected to more than triple. We're looking at about $1.615 billion, which gives us this really fantastic global compound annual growth rate, the CAGR, of 10.3%. So yeah, this isn't just niche growth, it's real market acceleration.
Right, 10.3% globally. That's definitely robust expansion. But like you said, the really interesting part is where that acceleration is coming from. Geographically, one region is clearly setting the pace, and that's Asia Pacific. It wasn't just the biggest revenue generator back in 2021, pulling in nearly $189 million. It's also projected to keep that lead, potentially soaring towards, what, $657 million by 2033. And its regional growth rate, nearly 11%, is comfortably above that global average you mentioned. It really signals that the main engine for ionomer demand, whether that's solar, electronics, EVs, it's centered there.
Absolutely. And what's fascinating here is that the Asia Pacific story isn't just about size, it's also about incredible speed.
Mhm.
China, as you might expect, is the largest piece of that regional pie. It brought in over $61 million in 2021, and it's tracking an 11.1% growth rate. So that's huge volume, yes, but also really high growth. But if you're looking for pure velocity, the standout is actually India. India showed truly explosive performance. It's projected to have the highest growth rate, not just in APAC, but across almost every country listed here. We're talking a HGR of nearly 12%.
Right.
That suggests a massive build-out, a foundational expansion of the exact industries that need these advanced materials.
Wow, nearly 12% annually. That's staggering. I mean, a market almost quadrupling in size over that period just based on that pace. Why do you think India is pulling ahead of even China in percentage terms? Is it just starting from a smaller base
Yeah,
or?
I think it's largely that. It's a combination of factors, but mostly scale and starting point. India began with a lower revenue base, around $24 million in 2021. So naturally, any big new factory or large infrastructure project, it has a bigger impact on the percentage growth. China's base is much larger, so it's 11.1% growth translates into, well, far more absolute dollars being added each year. But India's rate definitely signals where a lot of the future capacity is being built out right now. It's a key indicator.
And it's not just those two giants driving things, right? You mentioned other high momentum spots like Singapore, over 11.4% growth, Southeast Asia as a whole, even higher at 11.6%. It shows this shift is pretty broad within the region.
Yeah, Asia Pacific is definitely the place to watch if you're focused on specialty polymers or related investments. Okay, so that's the high growth engine. But the real structural shift becomes maybe even clearer when we compare that to the, let's call them traditional powerhouses, North America and Europe. Here's where it gets really interesting. That volume versus velocity idea we started with, North America, for instance, still held a really substantial market share in 2021, about $132.5 million. But its projected regional growth rate, it's noticeably lower than Asia Pacific's. Comes in at 9.65%. And the United States is the big anchor there. It was the largest single market globally in 2021, valued over $107 million.
Exactly right. The U.S. delivers the highest volume, no question. It's got that huge, established industrial base. And it's projected to stay the largest single market through 2033, hitting over $320 million. But its growth pace is, well, it's stable, solid, but not aggressive, sitting around 9.5%. Now compare that stability to India's almost 12%. It really highlights the difference, doesn't it? North America looks like a market of maturity, maybe sustained replacement demand, whereas Asia looks more like a market of greenfield expansion. building new capacity.
It is interesting, though, that within North America, Canada actually shows a bit more momentum than the US, a 10.3% growth rate listed there. Are we seeing similar kinds of internal variations within Europe?
We are, yes. Europe follows a very similar pattern to North America overall. Large volume, but slightly lower relative growth compared to APAC. The regional pace is about 9.8%. Still, Europe's starting point is significant, close to $99 million in 2021 revenue. So that 9.8% still represents a lot of market value. And within Europe, Germany really stands out. While the region overall might be a bit slower than Asia, Germany is leading the charge internally. It's got the highest regional growth rate at 10.58%. So Germany, along with places like the UK and Spain, both showing growth over 10.1%, they prove that there are still pockets of really robust industrial demand, even in these more mature markets.
Okay, but let's push on that a bit. While North America's 9.6% is respectable and Germany hitting over 10% is good, that's still almost 2 full percentage points lower than India's rate. And we have to note Russia is listed as the slowest grower at about 8.5%. How do those slower growth rates in established areas affect, say, an investor's view? Thinking about risk versus reward compared to maybe more volatile but faster growing Southeast Asian markets.
That's really the central dilemma for global capital, isn't it? The mature markets, like the US or Germany, they offer lower perceived risk. They offer guaranteed volume for companies already established there. They feel like, well, safer bets. But the emerging markets like India or Vietnam or others in that high growth bracket, they offer potentially disproportionate upside because of that sheer acceleration, that high velocity. So if you're trying to capture the next wave of industrialization, you almost have to follow that double-digit growth, even if the initial investment size seems smaller. That kind of speed, that velocity, it's becoming too high to ignore, I think.
Right. And that focus on high velocity leads us nicely into the other regions, which show this isn't just an Asia versus West story anymore. This demand diversification looks like a global thing.
Precisely. It's much more spread out now. Let's look at South America. It's a market consistently showing signs of rapid industrialization in certain sectors. The regional growth rate for ionomers there is very strong, 10.65%. And within South America, Argentina is actually the pure acceleration leader. Its growth rate is projected at 11.18%. That's right up there with China and Singapore. Brazil is still the largest contributor by volume in South America, naturally, but it's also maintaining a very healthy 10.5% pace. It really confirms that the need for these kinds of specialty polymers is now deeply embedded in major South American manufacturing plants.
And the Middle East is showing a similar kind of pace.
It absolutely is. The Middle East regional CGR is 10.51%, very strong. And we see the same pattern. Diversification and high growth within the region. The United Arab Emirates, for example, is a high growth contributor, accelerating at 11.15%. Again, another example possibly tied to, major new infrastructure or industrial projects. Saudi Arabia is the largest market there, and it's growing very strongly too at 10.6%. And finally, Africa. While it's starting from a smaller base overall, it's still pushing a very respectable regional growth rate near 10%, 9.98 to be exact. South Africa leads the continent there, both in size and pace, coming in at a highly competitive 10.67% growth rate.
Okay, so we've toured the globe, basically. North America's stability, Europe's pockets of leadership, the really explosive growth in Asia, strong showings in South America and the Middle East. So what does this all mean? If we put all these data points together, what's the consolidated takeaway for someone trying to track these global industrial trends?
I think the key synthesis, the big picture is this. The story of the ionomer market is really a mirror reflecting global economic influence shifting eastward and southward. Yes, the U.S. holds the largest initial revenue base. It was the anchor in 2021, over $107 million, huge volume. But the future growth, the momentum, it's being overwhelmingly driven by emerging economies. Economies that are building out advanced manufacturing and infrastructure, sometimes from the ground up. Just look at the fastest individual national growth rates we talked about. They're all outside North America and Western Europe. You've got India at almost 12%, Southeast Asia collectively at 11.6%, Singapore at 11.4%, Argentina over 11.1%. For investors, it suggests that you might find higher proportional returns, higher growth on your investment in these emerging markets, even if the initial ticket size is smaller than placing a bet in the US or Germany. It's about that velocity.
Right. So to kind of wrap up this deep dive, the data clearly shows the ionomer market is growing consistently across the globe. It's on track for that $1.6 billion projection. Asia Pacific is definitely leading the overall charge in terms of both size and speed. But we're seeing really strong double-digit expansion in key emerging areas too, like South America and the Middle East. It really is a global opportunity set now.
Exactly. And maybe this leaves us with a final provocative thought for you, the listener. to mull over, one that really captures that whole volume versus velocity tension. We noted the U.S. was significantly larger than China in revenue back in 2021, right? About $107 million versus $61 million, a big gap. However, China's projected growth rate at CAGR is much higher, 11.1% compared to the U.S.'s 9.5%. Now, the projection for 2033 still has the U.S. larger in absolute terms, about $320 million versus China's projected $217 million. So the question to consider is this. Given that substantial difference in acceleration, that higher velocity in China, will China's trajectory narrow that gap enough after 2033 to genuinely challenge U.S. revenue dominance in the longer term? Or will that historical starting advantage, the sheer volume the U.S. already has, keep it insurmountable for the foreseeable future? Really highlights that difference, doesn't it? High volume gives you stability now, but high velocity, well, that often determines who wins the marathon. Something to think about.